Welcome to another episode of the Engineered Impact Podcast. This week we're talking about the best place to keep your savings. And if you've been following along this week, you know that to me, that is with a life insurance company. Okay. Now, banking is one of the oldest and certainly the most profitable businesses in the world. And for most people, when you think about where to hold your savings, money that you may need to access for some reason someday, most people think about a bank. Okay. We see banks as these pillars of strength in society, right? They have these huge, beautiful buildings in every major downtown in the world. They're the only non-governmental entities I can think of that deal with numbers in the trillions of dollars. We think they're strong and solid foundations of the financial system, right? Unfortunately, that's not really the case. If you're around for the 2008 Great Recession, you'll recall how quickly the banks started crumbling and went to the federal government asking for bailouts in 2008. The banks for several years at that time had been making insane loans to anybody with a pulse to buy real estate, regardless of whether they had a job, whether they had any real hope of making their payments. And there were all kinds of crazy things going on. Well, when interest rates started to climb, these subprime borrowers started to default in massive numbers, and the banks just absolutely crumbled under it. So a whole bunch of banks failed. The banking system was brought to its knees within a matter of months, and the banks all went to Congress, hat in hand, claiming that they were too big to fail, and the Western world would spontaneously combust if these banks went under, demanding billions of dollars worth of hundreds of billions of dollars worth of taxpayer dollars to bail them out, right? To make up for the stupid decisions that they'd made. Okay. Now today, it's 2020. Banks are in better shape than they were in 2008. But the question I have for you today is, how safe is your savings at your bank? Okay. Are your savings held at a financial institution with a strong enough balance sheet that you have confidence that your money will be safeguarded through thick and thin? Okay. Or are they held at a bank that you chose just because it happened to have a branch down the street that was conveniently located on your way into town or back home, right? Chances are most people don't take time to actually inspect the balance sheet of the bank where they hold their savings, right? We're taught to assume that the banks are safe, that our money's okay, and even if anything goes wrong at the bank, well, they're federally insured by the Federal Deposit Insurance Corporation, right? Your savings are backed by the full faith and credit of the United States government, right? So what could go wrong? Well, if you haven't noticed, the federal government spends way more money than they bring in. And if you've ever bothered to look at the Federal Deposit Insurance Corporation's finances, you'll recognize that if we had a widespread banking panic, very, very few people are actually going to have any money coming from the FDIC. So a couple of episodes I shared with you the 5 characteristics that I think a financial institution ought to have. And what we're doing this week is kind of deep diving on each of those. Okay, so as a quick recap, those 5 characteristics I think the perfect financial institution should have are: 1, they should respect their customers. Okay, they shouldn't jerk them around like the banks do. 2, your capital should be safe. You should have a high degree of confidence that your money is going to be safe and protected while it's held by whatever financial institution you're using, and then it's going to be available when you want it. Okay. And that leads into number 3, which is liquidity. When you want your money back, you should be able to get it back no matter how much you want at any time. Number 4 is the institution should give you a good rate of return on your money while they're holding it. And number 5 is I'd really like to get some tax benefits out of it, right? The only thing that's a bigger sucker punch than getting 0.01% on your savings from a bank is getting taxed on that 0.01%, right? So those are the 5 things I'd laid out. Today, I want to talk about number 2, safety of capital. Okay. So again, like I said a minute ago, I suspect very, very few people have ever bothered to pull up the balance sheet of their bank, but doing so is actually a very interesting exercise. Now, I've shared with you that I think the best place to hold your savings is with a dividend paying whole life insurance policy. Okay. With a mutual life insurance company. Now, I want to explain the difference. Okay. A mutual life insurance or life insurance companies are like banks. Okay. There are banks and their credit unions, right? A bank is owned by shareholders. A credit union is owned by the members, the people that actually hold accounts there. Okay. Now with life insurance companies, there's a similar setup. There are stock insurance companies that are owned by shareholders. And then there are what are called mutual life insurance companies, which are owned by those who hold whole life policies with that company. Okay. So I'm of the opinion that having a whole life policy with a mutual life insurance company where you are a part owner is the best way to protect your savings. Okay. So let me give you 3 reasons why I say that. First off, mutual life insurance companies have withstood the test of time. Okay. Certain ones. Okay. So I've got 2 of these accounts. One of these companies has been around for 140 years. The other one's been around for 170. Okay. So think about that. 170 years ago, 173 actually. So that was 1847 this company was founded. Okay. So think about what that means. They have withstood the Civil War. They were around for who knows how many banking panics between 1847 and today. They withstood the Great Depression, World War I, World War II, Korea, Vietnam, all of the wars in the Middle East, the Great Recession in 2008, and most recently, the crisis of the COVID-19 pandemic, right? They withstood all of that and are still, I would argue, the most financially stable and sound institutions in the country. Okay. So that's number one, is they've withstood the test of time. Now, a lot of these banks have been around for a long time too, right? But if you research the history of banking at all, what you'll find is that a lot of them have been on the brink of collapse a lot of times. And banking is a history of scamming and hooking each other up and bailouts and government hookups and central banks having to bail out banks. Banks have a history and a habit of running right to the brink of failure to maximize their profitability. And then when they screw up, running to somebody else to bail them out. It's a little bit disgusting, but these life insurance companies aren't like that. Okay. So that's number one. The institutions themselves have just proven over and over and over that they can withstand shocks and collapses. And by the way, these life insurance companies have never failed to make a payment on a claim. Okay. Now, reason number 2 is that the insurance company has a lot better balance sheet than your bank. Okay. So I went in and I actually pulled up balance sheets for a handful of large national banks and one of my life insurance companies just to run a comparison. Okay. So the first bank is Wells Fargo, which I would argue is one of the absolute worst national banks. Since 2016, they have been the subject of scandal after scandal after scandal that's been exposed. They habitually abuse their customers, and yet they still hold a ton of people's savings. Okay. I am not one of them, by the way. But here's some numbers. Okay. There are let's start here. So Wells Fargo at the end of 2019 had $11.4 billion in cash and coin sitting at their branches. Okay. That is a ton of money until you consider the fact that at the same time they had $1.33 trillion in deposits. Okay. So folks like you and me have trusted Wells Fargo with $1.3 trillion of their savings. Okay. And to back that up, Wells Fargo only has $11.4 billion. So you do that math, that's 0.9% of deposits that are actually held in cash at branches. Okay. So what that means is if 0.9% of the people with bank accounts at Wells Fargo went to Wells Fargo for whatever reason in the same day, same week, and said, I need my money back, they'd be out of cash. Okay. Now, obviously, it doesn't make sense that banks are going to hold $1.3 trillion in safes at the back of their branches, right? That's not how banking works. But what they do, in addition to the cash that they hold, is they buy a lot of bonds and securities that can be liquidated very quickly to back up their deposits, right? So I looked at that number next. So Wells Fargo has $405.8 billion in these kinds of equities that they could arguably liquidate fairly quickly, within days at least, to get people their money. Okay. So if you factor in that $405.8 billion on top of the cash that they hold, that gets them up to about 31.5% of deposits that they could cover. Okay. So within, let's say, a week, they could cover up to about a third of their customers coming in and demanding their cash. Okay. That's not bad. The next bank I looked at was Chase. Okay. huge bank here in the United States. Okay. They have $9.6 billion in cash. Okay. So a little bit less than a couple billion less than Wells Fargo, but they actually have more on deposit. They've got $1.35 trillion. Okay. So Chase only has 0.7% of their deposits covered in cash. Okay. So 0.7% of Chase customers come in, demand their money today. They're out of cash. Okay. They also have less in bonds. They only have $397 billion in bonds. Again, that's a lot of money. Gets them up to about 30%. Okay. So in general, the banks are kind of on par, right? They're holding a little bit less than 1% in cash. And they've got about, once you factor in their bond holdings that they could arguably liquidate in a crisis, they're holding about 30% of their customers that they could cover. Okay. But the other 70% are kind of out of luck, right? So realistically, what would happen is everybody would probably get something back if everybody wanted their money back at the same time. But some people are going to get left out in the cold, right? Now, the odds of that happening obviously are fairly low. Everybody wants their money back all in the same day. But when that happens, when a large percentage of their customers want their money back in the same day, that's called a bank run. And the banks end up shutting their doors for this very reason. They don't have the assets to meet their customer demand. Okay. Now let's contrast that with the numbers from the balance sheet from one of my insurance companies. Okay. Now they have $311 million in cash. Okay. But they only have $9.5 billion that in cash value, what's called cash value, that they owe their policyholders. Okay. So if you do that math, that's 3.3%. Okay. Now it's still not a lot, right? 3.3% of their customers come back demanding their money and they're out of cash, but that's over 3 times, that's almost 5 times the cash that Chase is holding. Okay. So that's the first thing. Secondly, this company has $10.4 billion in assets covering $9.5 billion in cash value. Okay. And liabilities to their policyholders. So that's 112.8% of their liability to their policyholders that they hold in assets, bonds, primarily bonds, that could be liquidated to cover their obligations. Okay. So think about what that means. Whereas one of these banks, 30% of their customers show up and they're out of everything, right? There's no more cash. There's no more assets to easily liquidate. They're done. Their doors are shut and they're probably in Washington, D.C. begging for a bailout on hands and knees, right? The life insurance company, on the other hand, could liquidate their assets, pay off every single one of their policyholders, and still have almost $1 billion of capital. Okay. That is financial strength. That is the kind of balance sheet that I want backing up my savings. Okay. Now, reason number 3 is when the banks want to save their money, you want to know where they put it? They don't keep it in their own institutions. They go deposit it with the life insurance companies. Okay. The banks go open whole life insurance policies on executives and key management personnel, and they use those policies. They use the cash value, the ability to liquidate those, to access those funds. They use it to cover pension obligations, to reimburse themselves for the costs of like employee benefit programs, because the cash value is also growing at 4 to 5%. Okay, so they can get a very healthy rate of return on their savings that they can't get in the bond markets anymore. Can't get rates like that anywhere in the bond markets anymore. I don't think even junk bonds are paying those kinds of rates today. But they also know that those life insurance companies have rock solid balance sheets and those funds are going to be safe. Okay. Now, one of the things that you're going to find is going to become a recurring theme in this podcast is that we want to understand how a bank operates, and then we want to do what the bank is doing. Okay. We don't want to do the things that the bank is telling us to do. We want to do the things that the bank is doing themselves. Okay. Because again, banking is the most profitable business. If we want to be financially free, let's go figure out how the most profitable businesses in the world are operating and then go try to do the same things, right? So if the banks are holding their savings with mutual life insurance companies, we should probably be doing the same thing, okay? So those are the 3 reasons that I'm going to argue a mutual life insurance company holding a whole life policy with a mutual life insurance company, it's a lot of words, but is the safest way to hold your savings. Okay. Again, so let me recap those. The Life insurance companies have been around for a long, long time. They've withstood every financial panic, every war, every crisis that the world's thrown at them for well over 100 years, weathered it all and done it without bailouts, without missing a payment to a customer, without any of that garbage, any of the shenanigans and scamming that the banks do. Okay. Reason number two, they're much, much better capitalized, much stronger balance sheets than the banks. Okay. And number three, the banks themselves keep their savings with these life insurance companies. And so if we want to mimic the banks, the most profitable businesses in the world, let's do the same thing they're doing. Why don't we keep our savings with the same institutions that they are? All right. So that's the safety piece. All right. Tomorrow we are going to talk about the liquidity piece and why holding your savings with these life insurance companies will give you better access, more easy access to your funds than any bank will ever do. All right. So you can look forward to that tomorrow, and I will catch you then.